Yeah, so today's chapter is evaluating a company's resources, capabilities, and competitiveness. It's very important that a company understands its own resources and they know how to make a cross-functional bundle of those resources, convert those resources into capabilities, and using those capabilities to create core competences which are unique to their business and to make sure using those core competencies, they can actually get an advantage over the competitors. Yeah, so don't worry if you're late, I'll mark you, so that's fine. So that's the key of, the key things that we're going to discuss in today's chapter, okay? The learning objectives, the first one, learn how to take stock of how well a company's strategy is working. Look at your own organization and ask yourself this question. Is the company strategy working? Is it getting you new business? Does it generate greater revenues? Does it generate new value for the customers? Does it keep you ahead of competition? Does it actually take care of the threats which are there out there in the environment? Does it utilize your strengths? Does it let you overcome your weaknesses? Does it keep off threats that you might have? So your strategies should work for you in terms of performance, in terms of how you can use your resources really well, grab those opportunities and overcome weaknesses and keep away threats as far as you can. If it's working that way, that's great for you. And if it's generating plenty of profits, increased margins, greater market share, great for you. So the company strategy, you have to look at it and ask yourself, is it working? And we want to also talk about the main things of this chapter, which is the company's resources and capabilities, which are central to creating the right strategy, implementing the strategy, and then evaluating the strategy itself. And the next part of this chapter, which is the third learning objective, is to discuss how to assess the company's strengths, weaknesses, opportunities, and threats, the SWOT analysis itself. Then we go off to the value chain activities that a company can perform. Every company is a combination of several activities, which we call as the value chain activities, which includes inbound logistics from suppliers, you procure, your operations, your manufacturing process, your distribution, packaging, distribution, and then after sales service, and then eventually profits. So obviously, these are value chain activities which are primary for every organization. So we can look at how to improve each of those value chain activities and make sure you're cutting down the cost. And whatever you do in the value chain activities, you do something different that keeps you preeminent, distinguishable, differentiated. That's the key. So the degree of differentiation is important. Cutting the cost and controlling cost is extremely important. And then making sure you're staying ahead of competition, that's also very, very important. So we're going to discuss that as the fourth learning objective for today. And the last one here, understand how a comprehensive evaluation of a company's competitive situation can help you as a manager take important decisions, what your next strategic move should be. And this is again the learning objective 5. Also, when you say evaluation, you're deciding what are the key success factors for your particular company in that industry. You look at your rival companies. You can rate yourself and you can rate your competitors based on those key success factors. Each of those success factors can have different weights attached to them. And obviously, when you do the ranking, you can figure out who is your closest competitor, who is the best in the industry. If there are close competitors, how can you do better than them? If there is a real high performer in your industry based on those key success factors, you might ask, what are the best practices they are following? Is there anything that we can learn from this company and can we do better than them so that we can reach up there? So benchmarking yourself against close competitors, benchmarking yourself against the best in that particular industry based on certain key success factors. It's a very nice way of looking at where your company is headed to, and then you're preparing for yourself for the future. That's the key. So these are the learning objectives for today. So the first thing, we want to evaluate a firm's internal situation. How well is the firm's present strategy working? Is it really working well? What are the firm's competitively important resources? What do we have as resources? What can we claim as our most important resources and capabilities? That's a question that we want to ask ourselves. If you have a company of your own, or if you're heading an organization, that's a question that you continuously ask yourself. Capabilities that existed 5 years ago may no longer look like capabilities now. They're no longer relevant today. So your company might want to procure, create new resources, combine these resources and create new capabilities. That's the key. The third, question that you want to ask to assess your own internal situation of the organization is asking, is the firm able to take advantage of opportunities out there? And can our strategy help in keeping away the threats? How do we overcome those external threats to its external well-being? That's important. The fourth question that you have to ask about evaluating your own internal situation is look at the firm's prices, the costs, and compare yourself with rivals. And ask yourself this question: are we creating enough value? If you're creating enough value, customers don't mind paying that high price. But if you're not creating enough value, if you're not differentiated, if you cannot translate that extra price that you charge from customers into something that's really valuable in the eyes of the customer, you have a problem. So looking at your price, looking at your cost, and seeing what kind of value you're able to turn out and offer to the customer, that's a question that you have to ask to understand your own internal situation. The fifth question that you're asking yourself: are we stronger? Are we doing better than our competitors? Or are we on par with them? Or are we way behind them? So you can always, assess yourself in that particular industry. Again, when we talk about industry, you remember the five forces model, Michael Porter's five forces model, right? We're talking of existing competition. We also refer to the threat of new entrants, the threat of substitutes, bargaining power of suppliers, and bargaining power of customers. Is that correct? So those are the five forces that we look at. In the last chapter, we were talking of the assessing the cumulative force exerted by these five forces when we assess the industry. When we do industry analysis, we're looking at the cumulative effect of all the five forces. And to ask ourselves this question: is the industry still attractive or not? So when we're doing that, we have to also assess not just our own capacity and our own abilities as a company, but we have to also assess ourselves against competition. So asking this question: are we stronger? Are we weaker? Are we on just par with other competitors out there? That's an important thing to assess your own internal situation as an organization. The last question, which is here: what strategic issues and problems should draw our attention? What are the things that we need to prioritize? What are the most important and urgent things that we need to resolve so that we are not overtaken by competition, that we are not left too far behind? And we want to make sure that our customers stay with us, we retain our market share, possibly grow in the near future, and improve our profitability. That's the key. So asking ourselves, what are the most important things that we need to pay attention? So these are a bunch of questions as a starting point to assess your own internal situation of the organization. The first question, which actually translates to the learning objectives that we have: how well is the company's present strategy working? So best indicators of a well-conceived strategy clearly say you should be able to achieve the goals that you're setting for yourself as an organization. I'm sure you recall we have different types of goals: short-term goals versus long-term goals. We have SMART goals, which are specific, measurable, attainable, relevant, and time-bound goals. We have goals which are financial goals that we refer to as lagging indicators. And we also have strategic goals, which are called as leading indicators. We discussed this in one of the previous chapters. So if our strategy is getting our company closer to achieving those financial goals, as well as strategic goals, I think the question, how well is this company's present strategy working, is well answered. You know that our strategy is working for us. The company is earning an above average, profits, for example, and we are doing, above average, when compared to other industry players. We are above average in terms of sales, in terms of revenue, in terms of market share. If you're doing better than above average compared to other companies in the same industry, I think this question, the question number one, how well is the company's present strategy working, is being answered as well, because we're doing better than the industry average. Now, what other indicators of strategic success? If you want to look closely of what shows that your company is working well, your company strategy is working, sales and market share. I just explained that you want your sales to keep growing compared to every quarter. You want your market share either to be stable or do better than last year, and then acquire and retain customers. So we want new customers. We don't want to lose old customers. That's the key. That means our marketing strategy, our sales strategy, our strategy for servicing, all that is working for us. Another key success factor, as I just mentioned, profit margins, net profits, return on investment, stuff which you see in Globus as well, those key parameters and measures. Those are important things because your product design has been great, your marketing effort is good, your sales promotion is great, discounts are working for you, your advertising budgets, they're getting you the kind of demand that you were looking for. So obviously your strategies and say compensation and motivating your employees and making sure you have the CSR practices to create the reputational capital and managing your finances really well, not having too much of loans where you have to service these loans by paying high amount of interest rates. So you're looking at all these important parameters, and one of them here is listed as increasing profit margins, which is a clear indicator of strategic success. That means your strategy is working for you. Growing financial strength and credit rating. Come on, there you go. Another thing from Globus as well, credit rating. You don't want to be suffering with too much of loans. You're not paying back your loans and then you're defaulting. Your credit rating is just going to go and it's going to plummet basically. So you don't want that to happen. You want to have a good credit rating out there in the market space. In times where you want to raise money, it's not a problem because your credit rating is good. And I'm sure all of you understand credit rating better than anyone else because having traveled to the US and from being from different countries internationally, that each of us have a credit history and our credit worthiness makes an important plays an important role in for us to be able to secure funding, to take loans for education, to take loans for housing. Our credit history is important. Likewise, for companies, credit rating is extremely important for their ability to raise funds in the future. Positively viewed by shareholders and customers, we want to create positive image. Brand image is important. Reputational capital is important. Customers want to transact and continue to work with a company that is socially responsible. The 3 Ps in management. We talk about profits, great, but let's not forget people and let's not forget the planet. So these are called the 3 Ps. I know marketing has 4 Ps. We have 3 Ps in management: profits, people, and planet. You can put it the other way around. You can say planet, people, and profits. So obviously you want to create a positive image, be responsible towards the planet, treat people, whether it's within the company or your customers, with dignity and respect, and there's no discrimination. You're fair and just in your practices. So in that way, you're creating a reputational capital, which creates a positive image among shareholders and also among customers. That's another key success factor, showing that your strategies are working in your favor. Then you have leadership, obviously relevant to the market industry. If you have leadership that's evidencing a proper vision for the future, you're coming up with the right strategic intent, and you know exactly the path that your organization wants to tread in the future. And that's a clear indicator your strategies are paying off. And continuing improvement in operating performance, ability to control cost, to cut down, wasteful activities. You don't want to duplicate work. You want to reduce the number of, cost escalating activities in your value chain. If your operations are lean, and that means your strategies are working for you. You're not losing money. So once you've done that, identifying the components of a company's strategy. So there are plenty of, I think this is what we discussed in the first chapter, if I believe, maybe even the second chapter, and I don't recall exactly the chapter number, but these are different possible ways that you can come up with a strategy. So let's discuss, very quickly. It's like a recall. I don't know if you recall seeing this slide before. I do. Maybe I'm mistaken, but I'll go over them very slowly. So if you're talking of company strategy, it could be lower cost relative to rivals. That could be a strategy. Like Walmart, for example, they can actually offer everything at a lower price than their competitors. That's a strategy. How do you build competitive advantage? How do you do better than your rivals? One is low cost. The second one is a different or a better product offering. That means you want to be a distinguishable product. You want to give a service which is better than everyone else. And so you're extremely differentiated. The third one, you have a market niche that you want to actually serve. So you're actually creating very specialized, customized product or service, tailor-made for a very small market segment. And obviously, because it's for a very small market segment, it's price premium. So that's what we call as niche marketing or niche strategy. Then efforts to expand to a narrow geographic coverage. So you might perhaps identify certain market segments, certain communities that have very specialized needs or requirements. You could expand to those narrow geographic coverage areas if you choose to. You can build partnerships and strategic alliances with other companies because you can actually learn from their core competences. You can leverage those core competences that your partners have, your alliance partners have, and that way you're expanding your presence, you're expanding your learning curve, and then you have a wider product range or a service range, and you can reach out faster and you can grow. There are other ways you can focus on strategy as well. Moves to respond to changing conditions in the macro environment or in industry. Suppose you have the pandemic and you realize your current format of business is not working for you. How would you support your current revenue streams? By going online or going direct door delivery? Different types of marketing might help you continue to have 2 or 3 revenue streams. New York Tech, for example, we offer programs at the undergraduate and the master's level. Can we do continued education for those who are coming back for whatever reason they could not have opportunities to finish off their bachelor's or complete their master's? They can come back. Or can we have executive training? Because training is something that all companies look at. Can we do some consulting because you have special situations? And New York Tech has smart students and faculty who can team up together and work on specific industry related problems. So these are, strategies to reach out for changes that are happening in the macro environment or in a particular industry for New York Tech. You can also do planned proactive moves to attract new customers, improving the product design, adding some features, improving the quality, the durability, maybe better user interface, or a wider range of product selection. That's part of consolidation. Lower prices because you understand there is a downturn in the economy. People do not have as much disposable income. The only way it could be lowering the prices because you are able to accomplish economies of scale. So these could be possible, strategic approaches for a single business company. Then there are key functional strategies. You might focus on R&D, try and create new technologies yourself, like 3M does, which we discussed in the past as well. Supply chain management strategy. Many companies during the COVID have suffered because of supply chain issues. So you might want to create your own supply chain, some of the components, raw material. You perhaps want to control those supplies. You might manufacture some of your components. Production strategy, better automation, more stringent quality control, greater efficiencies, change in the materials used, maybe having procuring low cost but high quality supplies. There could be plenty of things, changes in the processes that are involved in production. So these are strategies to improve the quality, to improve your efficiency, control costs. You can do plenty in the production area. This is basically the value chain. You have the supply chain, the production, then comes sales, marketing, and distribution. So you could cut costs, and if you have efficient salespeople, they can save you money, they can save you time, they can get you new customers. Marketing can be efficient. You don't spend enough, you have to do more advertising. If you think you're spending already too much on advertising, cut advertising costs. Make sure you have positive word of mouth publicity. Back yourself with quality, high quality service, customized service. And then, of course, if you plan to integrate forward integration, you could create your own distribution networks. You could partner with another company which has a strong established distribution network. So there are plenty of strategies that are available here in this function. Then you come to information technology strategy, talking of data analytics, business intelligence. Decisions can be driven by using technology, computers, and plenty of algorithms that can process tons of data and tell you exactly what to stock, what to produce, where to sell, where do you have these cycles of demand and low demand and high demand, and what are the patterns of purchasing by different customer segments. So all that information is fed from your IT strategy. HR, I think you understand, you don't want to employ too many people, more than what you require. Right sizing is the buzzword today. You don't want to have too many, you don't want to have too less people. You want to have the right number of people doing the right set of jobs. You want to retain talent because your people will determine how good your company is going to go moving forward. So that's HR strategy. You're talking of finance. You want to make sure that you're managing your finances really well, and you're doing your financial health of the organization is great. So there's plenty of stuff that's going on in this particular slide when you're talking of components of a company's single business company's strategy. Not necessarily all these things have to be done at the same time, but several of these things can exist at the same time as part of a company strategy. Any questions so far? Okay. So we have some key financial ratios, which I will go over very quickly. So gross profit margin, the formula is there, the revenues, the cost of goods sold divided by the revenues again. So that will give you a gross profit margin. You want to keep it healthy and going. Operating profit margin, you want to make sure that you're generating enough of operating profit, your ability to cover all the expenses, operating expenses. So it's also can be calculated by dividing operating income by revenues. Net profit margin, you want to make, uh, the provision for taxes, calculate profits after taxes divided by the revenue. So that's what net profits that you have with you. Return on total assets, it's profit after taxes plus interest by total assets. So do you have enough profits, which can be, covering all your total assets that you have. Return on stockholders equity, again, taxes that can take care of equity, the amount of stockholders equity that you have. Same is the case with return on invested capital. Now, when you talk of invested capital, you're combining long-term debt and total equity in the denominator. So that becomes your invested capital itself. Earnings per share, again, in Globus, this is one of the measure. Profit after taxes by number of shares that are outstanding, common stocks that is outstanding, and you want the EPS to be as high. Guys, when you're playing the Globus game, make sure your earnings per share improves. I've just noticed that companies have very low earnings per share and return on investment, and these numbers are not that looking that promising. So you have to play the game a bit smarter. I'm not saying necessarily the game is really a smart game, yeah, but understand and how the game behaves. So tweak the numbers the way you can actually maximize the earnings per share, return on investment, improve your credit rating, and whatever revenues that you have. Then you have other ratios called liquidity ratios and leverage ratios. Some of these ratios are extremely important. Look at the current assets versus current liabilities, the current ratio. You want to make sure you have enough assets which cover your current liabilities. You have enough current assets like bills receivable, cash receivables, and all these current cash in hand itself. So all your current assets should be able to cover your current liabilities, all the payables that you have. Working capital, again, if you're short on working capital, you might struggle to have your daily operations being taken care of. So do you have funding sources to cover your everyday operations? So do you have enough current assets that can cover your current liabilities? So these are some of the ratios which actually talk to the health of the financial health of your company, how good it's doing. Debt to asset ratio, generally, that's how much of debt you have in comparison to the total assets. Then you have something like debt to equity ratio. Generally, they say a 2:1 ratio is a healthy ratio. Two times the debt and one time the equity itself. So you're actually borrowing enough capital. You're actually borrowing enough debt, and so you're leveraging on. You have this financial leverage basically. So these are some of the ratios that you should be aware of and you should be able to make interpretations of to figure out if your company is doing well. And then there are activity ratios which talk of inventory, days of inventory, inventory turnover. and average collection period. So all these things actually talk about how you manage your inventory. And these ratios should be strong enough. And you don't want to be in trouble when you have too many outstandings and you have a lot of accounts receivables. You don't want to have that. You want to make sure you're getting your payments done whenever you sell, whenever you're actually getting rid of your inventory. You have to receive accounts receivable should be there strong enough. Okay. So obviously, these are some of the activity ratios that I'm sure you took them in accounting one and accounting two. So I'm no accounting expert to talk more than this. But these are important financial ratios that all management students and managers must be aware of. Question two, we've come to the second question. What are the company's resources and capabilities? Now, competitive assets for any company are those resources and capabilities that we might be physical resources or intangible, tangible and intangible resources. You might have buildings, equipment, machinery, factories, all these tangibles. You might have intangibles like goodwill, reputation, the social capital, your own employees' intellectual capital, your networks with clients and with customers and with suppliers. So altogether, all these resources are extremely important assets. These are competitive assets. Capabilities are what the company can do really well. What are they expert in? What do they do? Things which are difficult to imitate. These are stuff that you cannot do as good as them in a short period of time. Definitely not. So competitive assets are resources and also capabilities. And competitive assets are determinants of competitiveness because they keep you ahead of your rivals. If you're very good at something and if you have certain strong assets with you, you can stay ahead of your competitors. That's the key. Competitive assets are they actually keep that sustainable advantage. That's why you call them competitive assets. Otherwise, you can simply call them as assets. But these are competitive assets because they keep you ahead of your competition. So resources and capabilities, resources and input, like a fleet of oil tankers. It could be anything physical. Capability, something that you can perform really well. Superior skills in marketing, superior skills in, say, design of a new product. These are capabilities. And companies have not one, but more than one capability. And they have more resources as well. So types of resources, as I said just now, you have physical resources, financial resources, technology assets, organizational resources. Each of those resources can be combined in ways that can give you a capability. Okay, some of the physical resources coupled with, say, technology resources, coupled with, say, organizational resources, coupled with, say, human assets, smart people. Together, we might create a strong capability. And so good we become that other companies cannot do the same thing so well. And even if they can, they're going to take a lot of time and it will take a lot of effort. And that's why these are core, unique, distinctive competences. They become core because they're central to what your company does. They're distinctive because nobody else, none other company has it. And they're competitive because they're giving you that advantage over your rival firms. Anyway, so you can combine these resources. Intangibles, human assets, intellectual capital, the brains that you have, and the reputation that you've created for yourself, and the brand image that you have at the workplace, at the market space. External relationships, that's what I was mentioning, networks that you've created, distribution channels that you've created. That's something, and the trust that you have in the market space. This is a trusted brand, and they're ethical. We can put our investments there. So these are intangible resources. Company culture, strong. Google, we spoke about Google several times when we talked about company culture. These are intangible resources. Clients want to work with Google. Customers don't want to leave Google, nor do employees want to leave Google because they have a strong incentive system as well. So altogether, these are types of resources. Now, this is what I said is like identifying resources and capabilities one thing, but how do you actually combine them? Is the resource or capability valuable? Is it rare? Is it something that others do not have? Is it something that might take time? It's something that it might take time for someone else to copy. So it might take a while before others get there. And that's why these are important for keeping you ahead in competition. That's why they're called competences. That's the reason. These are extremely important. And are there good substitutes available for the resource? Maybe not. Smart people cannot be found everywhere. So certain intangible resources, you can't find them. Great leaders can be found everywhere. So some of these resources are those, okay? Capabilities. Now that's the key, cross-functional bundle of resources. You're combining several resources to create a capability that you can do a critical activity really well, proficiently. You can do that particular activity really, really well. And that becomes a, see, everybody could make a laptop. But to make a good laptop, you need a capability, plenty of physical resources, R&D resources, and smart people working together with the best technology possible, with great quality control if need be. And altogether, you have a great product. So organizational capability is a combination of several resources. And then, of course, it's also because of the knowledge which resides in people, intellectual capital which is there, and or which is, that kind of knowledge resides in organizational processes, in the systems. This tacit knowledge, which cannot be documented, which cannot be written, is an extremely important capability. So that's something that you want to leverage to your own advantage to create a core competence. Question 3 is SWOT analysis. So is the company able to seize market opportunities and nullify external threats? We want to grab those opportunities. We want to overcome the threats that we have. So SWOT analysis is a great tool for not just companies, for you and me. We need to look at our own strengths, because your strengths will drive the strategy. It's the basis for your company's strategy. And what are your weaknesses? Lack of resources, lack of capabilities is a weakness. Any strengths, any capabilities you have is a strength. So you need to know both what you have and what you don't have as a company. So you try to leverage your strengths. You make sure you can fend off rivals from attacking on your weaknesses. And you have plenty of opportunities yourself. That becomes part of your strategic objectives. This is what we want to achieve. We see an opportunity here. And then you want to create strong strategic defenses against possible threats, threats from new entrants, threats from substitutes, threats from competitors. So you want to make sure existing competition, existing rivalry can be a threat. New entrants, new companies doing the same business can be a threat. A threat also can be because you have substitute products emerging. So how do you use your resources, your strengths, your capabilities to keep your threats away? So those are your strategic defenses. And then you have strategic objectives that you want to pursue a particular opportunity in the market space before anyone else does. You don't want to be late. You want to move in early. Make sure you make the best use of your, first mover advantage. So all this is, possible because you've done a very thorough SWOT analysis. And why do we do that? Because we want to make sure we understand ourselves, we understand the threats, we understand the opportunities that are there. We also know what our weaknesses are, and that's why we know how to fend for ourselves. Now, I explained briefly about this. It's an activity that a company can do very well, proficiently. That's a competence. And that competence, if it is central to your company's strategy, it's called core competence. I don't want to be good at doing something that does not have value to my products or to what I do. If I'm good as a company, we want to be good in stuff which actually contributes to our products, which contributes to our customers. So that's what we call as core competence. New York Tech, core competence, education, high quality education. New York Tech, core competence should be career-oriented education. That's what I look at it, core competence. New York Tech, core competence should be able to actually contribute to the industry, community, and the society at large. Be socially responsible. New York Tech, core competence could be research to make a difference in the world. New York Tech could be leveraging technology to help decision making for companies to solve problems again. or to create leaders for the future. So I think those are core competences that you want to achieve. And then what distinguishes you, what makes you preeminent and what makes you distinguishable. So that's the key. You cannot just do what others do and hope that you will be identified, that you will be chosen over the rest. You have to do things which are distinctive, which make you distinguishable and preeminent. You have to be very good at it. Only then you have distinctive competence. That's a key. How do you keep your position? You might get an advantage. You want to keep it, sustainable advantage, for which you need not just one, maybe several distinctive competences. Might be a question in the exam. What's a competence? What's a core competence? What's a distinctive competence? Support your answer with examples. So pick and choose a company. Apple, competence. They're very good at designing their products. Design, not manufacturing. Core competence. Their core competence could not be their hardware. It could be an ecosystem, their core competence. Distinctive competence. It's extremely, whatever services they give you, it's a finished, polished product. And maybe security systems, the encryption that they have. Your information, your data is going nowhere. So obviously, that could be a distinctive competence. And they continue to innovate. They continue to roll out, performance improvements on their software. So, so all those put together, you're talking of competence, very good at designing, very good at creating an ecosystem, very good at servicing and continuing to innovate. Perhaps those define Apple's case. What are your weaknesses? That's what we said. If you're not having certain assets, you're doing bad in certain areas, those will bring you a disadvantage. Those become your weakness. It's a competitive deficiency. Types of weaknesses, inferior skills. Imagine if we have employees who have poor skills, who are not the smartest people, who don't have the right expertise or experience. Weakness. Physical assets. We don't have the right set of physical assets. We don't have organizational resources. We don't have the finances. Well, these could be a weakness. We don't have the technology developed. We depend on someone else for technology. It could be a weakness in the future. Missing or inferior capabilities. We are not very good at doing something. That could be a weakness. These are possible examples. Opportunities. These are absolute must pursue. There is my dean who always told me, don't use the word should. You use the word must. He said, I should have said this, I should have done that. No, I must do this. So he doesn't like the word should. He says you use the word must. So when you have an opportunity, you must. It's not like you should. I should have. No, you must. Because these are market opportunities. Grab them and figure them. Where are they? Spot them. And once you figure out where your opportunities are, just grab them. So then those are opportunities. So they present high risk. And sometimes if they're high risk and questionable profit, maybe not the best opportunity. Unmatched, unsuitable and mismatched market opportunities. The strengths, we don't have strengths to grab that opportunity. It's still, opportunity is there for someone else, not for us. So you want to make sure there must be three categories here. The must pursue, and we have the strengths to pursue them. Something that is high risk and not sure if you're going to make enough money. So you're not 100% sure about it. You have to rethink. There's stuff which you cannot do. We're not in the same league in terms of strengths that we can pursue this opportunity. This opportunity is for the big players. So you have to figure out what kind of opportunities you can, you should, you must, and stuff that you might want to consider for the future, stuff that are beyond you. So opportunities, I might ask you a question in the exam. Do a SWOT analysis for a company that you like and you're familiar with. And the last one is the threats. Type of threats can come from everywhere. Normal course of business threats, sudden death threats of a business. It can happen because of COVID. Suddenly you go out of business. There are many shops, many businesses which are closing down. And then you have other considering threats. You might have to look at, identify the threats for future prospects, evaluate what strategic actions can neutralize or reduce the impact of these kind of threats. That's an important thing that you have to do. Question 4, any questions till now, till 3? So we did We figured out what questions we have to ask ourselves to assess our internal situation first. Then we went off to asking questions about, how do we know if our strategy is working or not? How do we evaluate our current strategy? We also looked at what are the important things that we should be doing in terms of figuring out, a SWOT analysis. So, any questions till now? Okay. So the next thing that we have to ask ourselves is the firm's prices and costs competitive with those of key rivals? And is it appealing in terms of value? The three things: price, cost, and value. You have to ask yourself, are you pricing competitively? Can you control costs? And can you create value? So what's generating your competitive strength? It could be cost, it could be value. And obviously you can do that by cutting costs, working more efficiently, or you could create a lot of differentiation, more value. Your product is so appealing, it creates this distinguishable differentiated value for customers. So its prices and costs are in line with rivals, its customer value proposition is competitive and cost effective, its bundle capabilities are yielding sustainable advantage. So why does Apple make so much profits? Because they control cost manufacturing out of Foxconn in China and other manufacturers in India and other parts of the world. Their design elements get done all in in California, and they're able to create that extra value, which is differentiated for their customers. So that's a source of competitive strength. Control costs, create more value, be distinguishable. We move on to the next most important thing under this question, which is value chain, a company's value chain. This is an important question, guys. I'm going to ask this in the exam for sure. Now, whatever a company does can be segregated, classified under two broad categories: primary activities and support activities. Every firm, big, small, large, for profit, for not for profit, probably will have most of the primary activities, some of the support activities. You don't have to name them exactly like this, but this is a very, generic classification of what adds to the value to all the activities that are done in the company. So the first value chain, primary activity is the supply chain management. How do you manage your supplies? Look at it. You do not, if you remember bargaining power of suppliers from Porter's five forces model, you do not want to be at the mercy of your suppliers. You want to make sure you have enough suppliers, and you want to make sure that they do not have too much of bargaining power. The second thing is so that you can cut down the cost. There is cost here. Also, you want to make sure that the supplies are of the best quality, because supplies will determine how good your product is. Differentiation can happen at the supply chain level itself. So if you procure poor components and poor raw materials, poor quality stuff, your finished product is going to be bad. So you want to have the best quality of supplies at the lowest cost possible. So you can work both strategies: low cost, differentiation. You can do both together. You can balance both. That depends on how good your strategy is in terms of how you're bargaining with your suppliers. So please, I'm explaining a lot of stuff here. So think about it. If you want to put a mobile phone together, you're manufacturing a mobile phone. There's a processor, there's a camera sensor, there are other electronic components involved. There's a beautiful screen. There is a metallic magnesium alloy construction. There is corning glass on the top. All kinds of material go into manufacturing a mobile phone. Then you have an operating system, whether it's iOS or it's Google operating, Android operating system. There's an operating system as well. There is brains into the mobile phone. Oh, there are plenty of suppliers. You want to make sure, cut down the cost. Don't compromise on the quality. It would require a lot of effort from your side. Managers in your company have to think smart, negotiate hard, and get the best quality supplies, timely supplies, lowest cost possible, and the best quality possible. So that's an important primary activity every company does, whether it's a car manufacturing company, a mobile manufacturing company, a television manufacturing company, any kind of company. Then comes operations, putting the putting the pieces together, putting the components together. You might have a poor technology, which is increasing your cost. You might have redundant activities in the manufacturing process, which are escalating the cost. You might have poor technologies, which are contributing to poor quality finished product. You want to upgrade your technology. You want to train your workers on the production process. You want to reduce the amount of wastage. You want to be efficient and produce as many as quickly as possible. Cut costs, improve quality in every step in the production process. You can do both. Okay? How do you do things? You have to work on both. Cut costs, produce the best value for customers. The more efficient you are in using technologies, the more efficient you are in using skilled people at the workplace in operations, the better it's for you. Once you have the finished product, you want to distribute. I have a great product, but nobody gets hands on this great product. It should be available. How do you distribute? Best Buy? Would you put it in Costco, in Target, in Amazon? Or you create your own website? How do you distribute? So you can have your own distribution network. You can depend on some other distribution network. Car sellers, they distribute using other distribution networks. Some of them have their own distribution channels. So distribution channels, are they working for you or not? Not. What is the most efficient way of distributing? Do you have your own distribution, or do you depend on some other, distribution networks to sell your product? Which is working? Cost effective, should be available, it should be high quality. These are the important things. Then comes sales and marketing. So obviously, your sales personnel should be able to describe all the technicalities of the finished product. And somebody walks into the store, and if there's nobody explaining about the product, I wouldn't know about the product. It's a great product, but nobody's talking about it. Nobody can show it to me. Nobody can demo that to me. So salespeople, very important. Marketing, you know the trends that are there. When do people purchase certain products more? Which markets the demand is really high? What kind of offers will sell? What kind of discounts and promotions can be done? What kind of market segments? Which different income groups should I have a different marketing strategy? How many sales personnel should I have? What kind of training should I give them? I don't want to escalate my cost. I don't want too many people. I don't want to waste time and money in training people that I don't need. I don't want to give too many discounts. It'll take away my profits. I don't want to give too much of promotion, but I still want to. How much do I spend in advertising? And is the advertising creating more demand? Is it resulting in higher sales? Which channel should I advertise? Which media is more effective? Does each market segment, different customer segment, look at a particular medium for advertising? So many questions you're asking. Control the costs. Don't waste money on doing stuff which is not increasing your sales. Don't waste money if it's not getting you higher demand for your product. But still, you need to spend where it actually gets you results. It has to be different. It has to be unique. It should be value adding. Everything that you do has to create value. That's why it's called value chain. Every activity here, some value has to be added. Cost has to be controlled. You cannot eliminate cost, but cost has to be controlled. Make it unique, differentiated. Every activity, differentiation. That's the key. And then comes service. There's so many companies that do service. How is your service better? How is it more timely? Better quality? Lower cost for your company? There are plenty of things even in service. How many service stations do you have? How much is the cycle time? When I send a product for service, how long does it take for your company to get back my product? And during that 2-3 days time, do I have a replacement unit? Suppose I send my computer laptop for service. What will I use today, tomorrow, day after, till I get back my laptop? Do you send me a replacement for these 3 days? Good customer service. Offer. I might not need it. I might have a secondary device, but at least offer. So you're thinking beyond, outside the box to create value. At the same time, not just do redundant activities that simply add to drive cost elements. Control costs, but be differentiated. Create value for customers. Customers should say, wow, This is great service. We really value this company. We'll go back because the service is great. Automobile companies, service has to be really good, not just the product itself. When you add value in each of these steps, that contributes to something that you're looking for, profit margins. Everything, whether it's a hotel business, whether it's educational university, institution, whether it's automobile manufacturing, whether it's mobile company that manufactures cement, I don't know. Anything can be classified into these, not specifically these names, broad categories. There should be some suppliers, there should be some operation, some distribution, some sales, some marketing, some service, eventually profits. Then there are support activities at the bottom. Product R&D. You have a product, you cannot think that product will keep selling forever. You need to research, put money there, continue to innovate your product, improve your existing product, or create new disruptive technologies. Systems development, because you need data to feed into all these value chain activities. HR, you need smart people to do all these beautiful things. Who will create new products? Who will know how to operate the technology and create the best production processes? Who will operate the distribution network? Who will do the sales and marketing? HR. They need to train, recruit, train, develop, keep them motivated, and retain them. Support activities. Then comes general administration, safety, whatever, payroll, and all that kind of, safety issues and compliance issues. All that comes under general administration, top management, and everything. Put everything there, including leadership there, support activities. Again, you don't want to waste money here, cut down the cost, and make sure you're contributing to the primary chain as much as you can. Questions? Okay, cool. You don't ask me questions, I'll keep going on and on and on. Okay, then comparing the value chain of rival firms. It's not enough if you just know your own company's value chain. Activity by activity, compare how other companies are doing their value chain. We want to see how they are doing it. Are they doing it better? Are there things that we can learn from? Is there something that we're missing out? Are there certain activities that we do for no reason? Are there some activities that we can combine? Are there some new activities that we should introduce? In any of the value chain activities, compare yourself, especially with some other company which is doing better than you. There's no point in comparing yourself with a company that's doing worse than you. So compare your value chain with the other company's value chain. It's a great way of looking at value chain analysis. Is amazing, man. If you understand value chain analysis, you know how to do business. Okay, so you're taking this in the business policy and strategy course, perfect course. So when you go out there, you can act like a consultant. You can tell them, guys, I need to understand your value chain. Let me know how you're doing stuff. I can tell you where you're getting it wrong, where you have redundant activities, where you're actually driving the cost up, where you could do things in a smarter way, where you could add value to your customers, where you could be differentiated. You can act like a consultant if you understand value chain properly. So the value chain analysis process also is segregate the firm's operations into different types of primary, secondary. I explained that. There's another important bullet here, activity-based costing. Every activity is looked at as, contributing to the cost. Every activity that happens at the workplace is adding to the cost. So ask yourself, is this activity really required? Does it add value or only cost? If it adds value, then it's okay if it's adding cost. But the value that it's creating should, actually be more than the cost you have to incur in doing that particular activity. That's why activity-based costing, it's called ABC, activity-based costing, very important. Every activity has a cost. You want to make sure it's generating more value. I pay you $1, I want value of $10. You do an activity, I have to pay you. When I pay you $1, I need $10 of value. That's how I'm looking at it. Businesses are operating that way. Do the same for significant competitors. Do an activity-based costing for your rivals as well. Smart way, value chain. Huh? This is an important thing. You looked at your value chain, you looked at rivals' value chain. You go take it to the next level. Look at the entire industry's value chain. Look at all the automobile manufacturers. in the US, for example. All the suppliers that are out there, you might not, procure material from all the suppliers, but assess all the suppliers. Look at all the suppliers literally, because it's the industry's value chain. This is your value chain as a company. And look at the distribution network which is out there. You might not use certain distribution channels, but study the entire distribution network. You want to also look at the end users value chain. All the end users who are buying your product or clients or services, which whoever, taking your services, study their value chain just to assess, can there be something that we can do better to use our suppliers, to serve our clients better? That's why you're understanding the entire value chain is such an important thing. Where do you fit in? And are you using the suppliers value chain? All the suppliers, or maybe you've lost an opportunity somewhere. So when you assess the industry's value chain, it presents to you unique opportunities that were not very obvious to you. And when you assess buyers' value chain, you understand your buyers' requirements better, the needs better. And you'll also understand how other companies are serving your buyers or the same type of buyers in a better way. So there's an opportunity for you to customize your product, customize your service, and to service your buyers in a better way that adds value to your buyers and their value chains. So this is what we call an entire industry value chain. So you start with the company's value chain, you compare yourself with your rivals first, and then you study the entire industry, that particular industry, whichever it is. Okay, questions? Benchmarking. So this is what I said, when you are looking at your value chain activities, and compare yourself with somebody who's doing, better than you, and you want to be happy by comparing yourself with someone who is exactly at the same level as you in terms of market share, size of operations. You might also look at other companies which are doing, worse than you, but then you're benchmarking against the best in the industry, which we call as best practices approach. So benchmarking, so involves improving your firm's internal activities. When I say activities, primary chain, and primary activities as secondary activities, and learning from other companies, and that's what we call as best practices. Assess whether the cost competitiveness and effectiveness of your value chain activities are in line with your competitors. Are you spending too much of more cost in doing what others are doing? You have to cut it down, find ways. Sources of benchmarking, you can get that kind of information from reports, trade groups, and analysts and customers. You can visit some benchmarking companies they have, and you can also, approach consulting firms. Of course, you pay for it. Nobody gives you data for free. Nobody gives you analysis for free. These are expensive, but if you want to do it, you should be able to pay for it. Now, if you find there is a problem with any of your value chain activities, that's what I was saying. Look at all your activity segments, look at all the supplier parts, look at your distribution channel portions of the value chain. Two things that you can do: cut costs, work on the costs, cost of supplies, cost of production, cost of technologies that you're procuring, cost of packaging, cost of quality control, cost of distribution, cost of sales, cost of marketing, right? Cost of service. Look at all those. And when you're thinking about differentiation, look at how differentiated your supplies can be, high quality that you can procure, high technologies you can use, great quality systems that you can put in place, and extremely crafty people, skilled people that you can train for using in the production process, packaging, extremely high quality packaging, distribution networks, very different ways of reaching out to customers. And then when you eventually do marketing, you bundle the product in ways that makes it look even more attractive. And when you do service, it's very custom driven, very specific to needs of your customer. It's extremely differentiated. We're focusing everywhere on differentiation. So that's what you can do. Question 5, is the company competitively stronger or weaker than key rivals? You have to, at the end of this whole thing, we want to ask ourselves, let's compare ourselves. How are we doing? That's where we define, the key success factors. So ability to effectively, efficiently bundle resources. That's what we were saying. We have some unique abilities. We have some resources. Can we bundle them together? Can we rank higher than other companies on key success factors? What is a key success factor in that industry? Generally, you take like 5 or 6 factors which you think are important in your particular industry. Each of those factors you can assign a weight. Each don't have to be equal in weight. Altogether, they have to be equal to 1.00. You give a fraction of weight for each of them, but when you add all the 5 or 6 key factors weights, they should sum up to 1. So you can, I mean, when I say you can call in experts, ask them in this industry, what do you think are key success factors? You can shortlist 5 or 6. You can assign weights for it. Then you identify rivals, rival 1, rival 2. Then you can rank your company versus those 2 rival companies on those key success factors. Multiply the ranking with the weights, you get a total score. And then that gives you a position. Whether you're top 1 or you're in the middle or you're at the bottom in comparison of a 3-company industry. For simplicity's sake, in the next slide, I think that's what is there. Step 1, make a list of industry key success factors. That's what I was saying. Usually 6 to 10 measures, not more than that. Step 2, you assign weights to each of those measures based on what you think is important. When I say you, it's experts who understand that particular industry. Step 3, rate the firm and its rivals. You're rating yourself and you're rating the 2 firms or 3 firms that you're taking. Multiply that measure with the weights that you have corresponding, that weight that you've assigned to each of those factors. And here you find what I was talking about. So look at the key success factors here. Quality is a key success factor, product performance. If you see quality, Q by P ratio, I think QP performance is there on Globus, right? Is it there? Quality and product performance, I think, is part of Globus, isn't it? Nobody's talking, and that surprises me. I'm not even sure if you're listening to me. Anyway, reputation image is another key success factor. Manufacturing capability is a key success factor. Technology, dealer distribution network, product innovation, financial resources, cost position, customer service capabilities. So they have defined 1, 2, 3, 4, 5, 6, 7, 8, 9 key success factors. They've assigned different weights based on the importance. Say cost position is having high, customer service is pretty high. There are many which are equal: financial position, manufacturing capacity, reputation, quality, and product performance having equal weights. The 3 lowest weights are given to technology, distribution network, dealer distribution network, and product innovation, equal, weights of 0.05. Together, if you combine all those weights, you add them up, it's equal to 1. And they've done for this company, which is your company, ABC company, they've listed 2 rival companies, rival 1 and rival 2. You rank them based on how good you think each of those companies are. You multiply it by the weights. So 8 into 0.10 is 0.80. 8 into 0.10 is 0.80. 2 into 0.1 is 0.20. Likewise, you have all the weights for company A, B, C, and then you have all the weights together added up for rival 1. You have for rival 2 add it up, it's 2.10. In this case, rival 1 is the top, the rival 1 company is the leader. You're in between and you have a follower. So you're in the middle. So you can always try and become this number 1 company. Where are they doing better? They're doing better, say, not in quality. They're doing better in, not in reputation, but they're doing really good in manufacturing. They're not better than us in technology. It's strange. They're doing really good in finances. They're doing way, way better in, say, what's this? It's cost position. And they're doing also better in customer service. These are areas where we have to benchmark ourselves and look at activities that rival 1 is doing and how can we improve our company's performance on these issues. And if we can, then moving from close to 6 to 7.7 should not be difficult. So that's what we call as comparing your company versus other companies, looking at the activities and benchmarking and against the best in the industry, and following the best practices, improving your own primary and secondary activities so that you can reach or you can do better than them. Strategic implications of competitive strength assessment: the higher your firm's overall weighted strength, the stronger its competitiveness is. The rating scores indicates the total net competitive advantage you have over the other companies, over company 2 or rival 1, rival 2. The firms with highest competitive strength scores are targets for benchmarking. That's what I was saying. Rival one is doing good in certain things. There are targets for benchmarking. The ratings also show how company compares against rivals factor by factor. Each factor you can make a comparison, or capability by capability. Things that you're doing better, continue to do it better. Things you're not doing so good, you always can improve. Strength scores can be useful in deciding what strategic moves to make. So you exactly know where to focus your strategies on. It's a clear indication that you don't want to waste your time on everything, but focus on things that you should be doing good at. The last question you have, once you identify strategic issues, the most important things, it calls for action. It calls for managerial attention. Top level, middle level, operational level, tactical level, all level managers must be able to focus on the most important things that we identified from the previous calculations. You're looking at questions like how. You're looking at strategic issues, how to keep off market challenges from new foreign competitors, how to fight against price discounting by rival companies, how to reduce high costs in our, say value chain activities so that we can have price reductions, how to sustain the growth trajectory in spite of slowing buyer demand or in spite of, say, the pandemic, for example. Whether we have to go and expand our firm's product line, should we introduce new products in each of the product categories, whether to correct the firm's competitive deficiencies by acquiring another company. Do we want to buy another company so that we can strengthen our technology, we can strengthen our own patents, and we can create new products faster? So acquisitions, like Google has acquired hundreds of companies. Maybe that's a way to go if you have the money. Identify strategic issues. It continues whether to expand into foreign markets rapidly. If you're not able to do business in China, would you want to go to other countries? If Chinese companies are blocked from doing business in the US, should they focus in Europe? Should they focus in Middle East and Africa? Should they focus in Australia and New Zealand? Maybe yes. Whether to reposition the company and move to a different strategic group. I'm sure you remember the strategic group mapping, right? You have those little bubbles that we drew, taking into consideration something on the x-axis and y-axis. So obviously, do you want to move to another quadrant? Do you want to move to another part of the matrix itself? That's a strategic question you're asking. What to do about growing buyer interest in substitute products? Just buyers are simply moving to substitute products. So what do we do with that? How do you fight against aging demographics? In countries where the population is getting older, how do you make them accept your new products? How do you make them upgrade? They might not even think of upgrading. So how do you deal with these kind of things so that your customer base is strong? So we just finished off this chapter on resources, capabilities, and creating a competitive advantage. If you have any questions, please feel free